Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, hi. Morning.
Hi, good morning. It looks like it could be a better day. For one, maybe we retrace some of the fall that we had in the last 1 hour, and plus global cues look fairly upbeat, particularly tech, US tech.
Well, that's right. Yesterday's fall actually was a little bit, you didn't feel very comfortable by the time we finished off. But hopefully things stabilize. We have the expiry-related factor as well that will play out today. But as you said, global cues looking better. And hopefully, all this...
The mid-cap should perform, right?
That's the big question, right? And I think some movement in terms of Ukraine as well. So hopefully we get some kind of, clarity on that front.
China, Ukraine,
yeah.
Lots of hotspots. Lots of hotspots. But hopefully, they'll all, as we wrap up this year and 25 days to go, the picture will look much cleaner, much better into 26. That's the hope at least, right? Now, let's start from the beginning in terms of what you need to know as we begin this session. Sharp rebound in US equities. And when I say sharp, the Nasdaq is up 2.7%. Now, that is massive, big, right? S&P about 1.5% higher. And it was largely led by, as you can see on the screen, technology names. NVIDIA was up 1.5%, Amazon was up 2.5%, Alphabet was up 6%, and so on and so forth. NVIDIA, the big one, of course, and I think this is the market reacting to Trump administration's report saying that they may allow NVIDIA to sell back into China. They've been out of China, zero revenues from China, and it's one of the largest markets for chips, advanced chips, AI chips. So that, I think, at the margin did help. Alphabet, that is Google, a 6% move. Gemini 3, and we spoke about this in some detail yesterday morning, right? Now, that's one bit, which is AI. So there have been two pain points. One, of course, this AI wobble and questions around ROI and whether more capex will go in, and will that further push out returns on investment, etc. That is still a question. I think we won't have the answer anytime soon. The other, of course, is much more immediate, which the market seems to be fixated on, which is the December meeting for the Fed. For some reason, really important, but market pricing for a December rate cut continues to rise. So that is, I think, the other one which is helpful. So last night you had one more Fed member, a voting member, sort of backing the fact that he'd like to see another rate cut. Although he did say it's meeting to meeting, but in December he'd like to see a cut. Macro markets, 10-year yield was down 3 basis points. The oil price went up about 1.5 Brent, so 63.4. But basically it's been bouncing around without too much directional move, big positional move. You have Ukraine's President Zelensky, and we'll read out the quote, like the exact bit in just a bit. But he basically, he said a lot. But he said that from what I could make out, he said, well, he's more open to the idea of striking some sort of a US brokered peace deal with Russia. And he kind of sort of alluded to the fact that what's being proposed now, as opposed to earlier, is much more streamlined. So does that bring us one step closer to so far, Ukraine has been urging Ukraine to fight. Ukraine has been saying we'll fight. They've been asking US for help. So this looks like they're cooling down in terms of their ambitions with regards to the war and what they can achieve there. Trump and Xi, right? That's the other one. President Xi of China, they held a call to discuss trade, Taiwan. There was, of course, a talk around Russia's invasion of Ukraine as well. And Trump essentially said that he's agreed to visit China in April, and he in turn has invited President Xi of China for a state visit next year. So this is, again, move forward, and that's the big rivalry, the big strategic rivalry, which is not going to go away anytime soon, but a bit of a thaw, as markets would like to see. Trump basically said our relationship with China is extremely strong. That's the other bit. Here in India, of course, markets have been, it's kind of one step forward, two steps back with regards to expectations of when we will see some sort of a thaw in India, US, but no sign of it at all. So we'll just wrap it out with levels and just support levels. 25,852. Yesterday's 100-point fall brought us closer to some of these levels. 25,852 is the 20-day moving average. It's been moving up. And, of course, for the Nifty Bank, it's 58. 363, which is the 20-day for the Nifty Bank as well. So those are levels. On the upside, I mean, there's a swing high. There's a bunch of resistance levels. You basically come off a little bit. So that is much more easier for both the Nifty and the Nifty Bank in that sense. But 20-day is like, as they say, the Lakshman Rekha, and we shouldn't come very close to it and, of course, not break it. And I don't think we will, at least looking at the overnight reaction. GIFT Nifty will give you a quick sense of where we are starting. We'll pick it up from there. There was in the morning, about 1.5, 2 hours back, some problem with the GIFT Nifty. It was not really updating properly. I hope these rates are correct. But what you have on your screen is about a 70-odd point lower implied open. Nigel is standing by with the F&O positioning and the stats. Nigel, over to you.
Well, yesterday's fall actually was a little bit worrying, the way we ended in trade. But, the hope is that, in fact, with global cues fairly positive, you'll want the Nifty to see some kind of a fight back in today's trading session. But the Nifty in yesterday's trading session, that fall was a little bit worrying. Now, in terms of the rollover picture, given that today is the monthly expiry, the Nifty more or less in line. The Nifty Bank relatively lower if you compare it with the last few series. So the Nifty Bank rolls are actually much lower in comparison to the averages getting into an expiry day. So there could be a lot of action left actually on the Nifty Bank in today's trading session. One of the factors that played out yesterday with regard to that fall was the FI, they turned sellers, close to around 4,000 crores in terms of selling. But two factors out here. One is getting into expiry day. And the second factor, there was an MSCI rebalance that took place yesterday. Net, there was supposed to be an inflow, but the gross volumes were massive. So, difficult to understand whether or not that 4,000 crores was genuine selling. Today, we'll get a better trend, I think, with regard to the FI net sell number. The DIs, though, they turned buyers yesterday. The FIs, after a while, they went ahead, they added some long positioning. They're still net short with close to around 86% of the positioning on the short side. But in yesterday's trade, the call writers, they felt that they're back in the game. And that was precisely what the FIs did as well. Aggressive call writing is what we saw in trade yesterday. And because of the kind of call writing that we saw, close to around 5 calls were written for every 1 put. You had the PCR that came down from around 1.4, just around 2 trading sessions ago. It came down to around 0.77 odd. So the PCR is moving to the lower end of the range after almost testing the higher end of the range at around 1.5 that we saw in the past week itself. So a couple of calls that were written should come up for you. 26,000, 26,100, 26,200. Aggressive writing is what we saw in yesterday's session. Which brings us to the levels then. 20 DMA, important. 25,850, crucial level on the downside. Last couple of trading sessions, we're going to around 26,150. The high is around this vicinity. And the options data as well suggests that in the near term, this becomes a bit of a resistance zone. So that's the important mark. And on the Nifty Bank, that's the one that will have to fight back. Rolls are relatively lower, and it's still trading comfortably above that 20 DMA or around 500 points higher in comparison to 20 DMA. So that's the one that will have to fight back today. But more than the Nifty, we're talking about levels close to all-time highs. I think the broader markets need to participate because there's been a stark underperformance that we've seen in the small cap index. And in yesterday's trade as well, all through the trading session, actually, you had the breadth of the market that was negative. So some stability on the headline index and some performance on the broader markets is something that the street will be looking forward to. Expiry day, final hour of trade will be extremely volatile.
Thank you. And let's get to the big equity calls of the morning then. It's Jonathan Garner of Morgan Stanley who says investors were generally constructive on the 2026 risk outlook and formed a strong consensus on US relative valuation appeal within Asia's growth and AI cohorts. He also says that their overweight view on India and underweight view on Taiwan are still contrarian, and most investors agreed with a K-shaped outlook for Chinese equities and upside for Japan.
So those are some views. Investors are weighing a possible Fed rate cut, right? After New York Federal Reserve President signaled that a third rate cut could happen this year. Here's some opinion from former Boston Fed President Eric Rosengren on why the votes of the Fed presidents and the chair really matter this time around.
I would be surprised if Steve Myron doesn't dissent for 50 instead of 25. I would expect probably 2 presidents to dissent for no cuts at all and the rest of the committee to go along. But I think the minutes are going to show that there was much more support for doing, if you look at the participants and not the voters, I think it probably, the presidents are strongly in support of not doing anything at this point. So it's a situation where the voters really do matter. And it's a big decision once the chair's made clear which direction he's going if you actually decide to go forward with a dissent.
Let's also listen in to what the former U.S. Secretary Jacob Jack Lew had to say about the markets.
Look, I think the outlook these days, you have to say, is uncertain. There's a lot of things that are very confusing. Even the jobs numbers that came in last week, you can look at one half and say it's good news, the other half say it's bad news. So uncertainty is the word I would use. When you have policy that's driving in an inflationary direction at a time when the deficit is as large as it is and growing, and the tariffs distorting so much that's going on in our economy, it's hard to say I'm comfortable. I'm not of the view that we're about to go over a cliff, but a shock could come and we're not well poised.
Well, fair bit of uncertainty, right? Absolutely right there. Let's just quickly take you through President Trump and, the post on Truth Social. And this is what he says, and I quote, "I just had a very good telephone call with President Xi of China. We discussed many topics, including Ukraine, Russia, fentanyl, soybeans, and other farm products, etc. We have done a good and very important deal for our great farmers, and it will only get better. Our relationship with China is extremely strong. This call was a follow-up to our highly successful meeting in South Korea. That was 3 weeks ago. Since then, there has been significant progress on both sides in keeping our agreements current and accurate. Now we can set our sights on the big picture. To that end, President Xi invited me to visit Beijing in April, which I accepted, and I reciprocated, where he will be my guest for a state visit in the United States. That is later in the year. We agree that it is important that we communicate often, which I look forward to doing. Thank you for your attention to this matter." That is a sort of, classic sign-off from President Trump.
Okay, let's just get Asia up for you on your screen. It's a very green-looking screen. The Taiwanese market's up close to about 1.5%. Korea's up about 0.8%. The Hang Seng, the last time I checked, was up nearly 1%. So all tracking that Wall Street rebound, and it's picking up now across the Asian market. But as you heard, what Prashant was saying, maybe the friendlier US-China narrative, Trump calling the relationship extremely strong, and the movement towards a peace framework in Ukraine is also supporting global risk assets today. Mark Matthews of Bank Julius Baer is now joining in. Mark, thank you very much for joining in. It's the final stretch of the year. How are you feeling about global equities, and what do you expect now?
Well, if I look back at the other years when the S&P returned over 15% in the first 10 months of the year, in other words, from the beginning of January to the end of October, there were 21 years like that since 1950. And 20 of them, all but one, had positive returns in the last 2 months of the year. In other words, November and December. So purely on that one technical observation, I would say that when you've had a strong year in the first 10 months, you almost always have a good finish. And of course, as you know, November and December are typically the best time of the year for the market, along with the very beginning of the year. So I think that we should end the year higher. The December Federal Reserve meeting is garnering a lot of attention. I think perhaps a little too much attention, because if they don't cut in December, we think they will definitely be cutting in the beginning of next year. But after the speech that Fed President Williams gave on Friday, committing to a cut in December, and so we can deduce from that Powell will want to cut too. And if Powell wants to cut, then Governor Cook will want to cut. And you can kind of add up all the people who will cut. A cut does look more likely. The futures market's pricing 75% chance of it. And I suppose that's the primary reason why we had the reaction we did in the market yesterday.
Absolutely, Mark. Morning. But in terms of what happens if President Trump, if he gets his way with appointing, his candidate as Fed chair in May when Powell retires, whether he'll get his way with much lower rates next year, that's also doubtful, right? As we've heard comments, the Fed members, etc., and pretty independent. They may want to cut in December more than, the greater number than those who don't. But, I mean, it doesn't look like they're all going to side with the view that rates should be a lot lower in 26. But that's another story. Just a quick word on the AI thing, Mark. We've been talking about ROI questions, etc. But there's this new thing, right? This Google Gemini, which basically topped the charts in terms of performance. Some say better than ChatGPT 4. Markets has been fixated around OpenAI and its ecosystem for where the winners will emerge from. And suddenly you've got Google, which kind of perhaps is the most complete full stack AI player, coming up with a great product. So does it push out expectations? All these ROI questions. I mean, it kind of makes everything much more difficult to answer at this stage, right? Who essentially will be the winner? So far, at least there was clarity that with OpenAI doing what it is doing, it is going to be OpenAI. The question was whether they're over-investing and whether they will make capital allocation mistakes, etc. But now there's this new one.
Yes. Isn't it interesting? And I must confess that I read Google totally wrong, because I was one of the first users of Gemini when they launched it. And I thought it was terrible. And so I immediately switched to another large language model. Now, of course, as you rightly say, it's top-notch, the best. And Google are making their own chips. They're monetizing AI through their many different platforms, not the least of which their own search engine, but also YouTube. And so they're looking like the winner. They are looking like the winner, and there probably will be more than one winner. But as you also pointed out, the market is worried about all the investment that's going into AI and whether it can be monetized. Some companies will lose a lot of money, the ones that are not the winners, if you know what I mean, the ones that do not end up having big market share. But I think we can start to see the horizon, and we can start to see that Google is going to be definitely one of the big players in the AI space for forever, basically. And of course, that's very meaningful. Because this is truly one of the greatest technological innovations in our history.
There was some commentary that OpenAI, ChatGPT has about 800 million active users, and Gemini has now it has hit 650 million. Almost. So it's very swiftly caught up, as he was saying, that first it was all OpenAI as the winner. Yeah. Look at Gemini's number, 650 million users.
Well, that's right. Mark, good to see you in as always. I wanted to bring us back to the Indian markets. What's the view out there? We've been relative underperformers. You're calling for a bit of a melt up towards the end of the year, as history suggests, that if we've had a good year, then normally the US markets, they end higher. What about the Indian markets? How are you feeling? And also, I wanted your call on tech. I recall a couple of interactions ago, you said that could be a contra trade. Indian tech companies that have underperformed, going by the commentary, going by the valuations, you would take it as a contra call. Last few days, in fact, that's playing out. And for the month, actually, Indian tech companies have been relative outperformers. Your view on them?
Well, I made the observation purely on a valuation basis, and looking at the biggest losers, this theory, the dogs of the Dow, that if you buy the biggest losers at the end of a year, chances are you're going to make money out of them because they went down so much. So India's never been a value proposition, but there is definitely value in the IT space. That's why I talked about it. And for India as a whole, I'm bullish on the market. That has not changed. I think the underperformance of India this year is attributable to the foreign selling, which was to finance a rebalancing in China, where foreigners were very underweight. And that should be largely done by now. I can't believe there's anybody who owned India and hasn't sold it yet if they were going to buy China. And then there's also the issue of the lackluster earnings for the last couple of quarters. And I also think that with the monetary policy changes this year and the tax cuts, we should look forward to an improvement in earnings for fiscal year 27. And if we're looking for earnings growth on the Nifty next year of between 16 to 18%. If we're right and the Nifty's back down at what I consider to be a reasonable price-earnings ratio, then I don't see why the market can't give you about 16 to 18% next year.
So India gets back to its outperforming ways, Mark?
I don't know if 16% will be outperforming China. We'll have to see. I would also expect China to give you, I'd say, somewhere between 10 to 15% next year. One thing about China is it is a very state-sponsored bull market, and they have the capacity to control it. They don't want it to become a parabola. They want it to be a slow and steady bull market so they can coax households to invest in it. And so I don't think that it'll get much above 15%. And on that basis, yeah, probably India will outperform China next year.
Yeah, state-sponsored bull market. But yeah, I mean, point taken. I think it conveys the meaning of what's happening. Temper too much and slow, steady, but a market which does well. Thanks very much, Mark. Great speaking with you. Appreciate you joining us here on CNBC-TV18. We'll take a quick look at what's coming up here over the next 2.5 hours or so. So we have at 8:35, Elara Capital's Karan Thorani joining us, and we talk about the impact of labour law on platform companies. And Karan has written about this subject. 9 o'clock, we have Equitas Capital's Vijay Agarwal to discuss the labour law effect on infrastructure sectors. 9:20, Axis AMC's Ashish Gupta is a market master today. We talk stocks, sectors. The management of GE Shipping will be speaking with us at 9:45 on the outlook there. And towards the end of the program, Lata in conversation with Harendra Kumar of Elara Capital on second quarter earnings, valuations, and his preferred picks. Okay, take a break. We are back. Our research team is standing by with the key stocks to watch on the other side.
Welcome back. You're watching Bazaar Morning Call. GIFT Nifty is flat. Let's wait by to see if there is some rub-off of the positive handover that we got from Wall Street before now. The implied open is down close to about 5 points. But let's straight away dive into the market action and get you the stocks that you need to have on your radar this morning. Vinny is now joining in with Siemens Energy first.
Hi, good morning. So Siemens Energy, they actually reported their number for the September quarter ended. So they report full year numbers as well. And the year ending is September. First, talking about this quarter that has gone by for them. When you look at it, revenue, profits of the company came in line with what the analysts were expecting. Margins, revenue profits were better. Margins were in line with expectations of what the analysts were expecting. Revenue growth of 22%. EBITDA seeing a bit of a decline of 1%. And EBITDA margins have seen a contraction significantly, 14.9% versus 18.5% last year, same time. Net profits of the company have seen a growth of 31%. Now, in terms of segments of the company, when you look at the power transmission side of the business, that has done very good in terms of this revenue growth, margins, as well as in terms of EBIT margins is what I'm talking about, and overall EBIT performance as well. So operationally, the power transmission segment has done very well because expansion in terms of EBIT margins, 18.15% versus 16.09%. Now, when you look at the power generation side of the business, they're seeing an increase in terms of the mix coming in from power generation business. But the margins over here, the EBIT margins, have seen a contraction coming in. So that is why overall, when you look at the margins, EBITDA margins of the company as well, they have seen a contraction, and mainly because of the change in the revenue mix where higher share is coming from the project business. Now let's move on and talk about other internals. When you're looking at the new orders that have come in for the company, stable at around 2,351 crores. Order book, that is very strong. That stands at 16,200 crores approximately. That's a 47% growth on a year-on-year basis as well. So very strong growth there. Net working capital for the whole year, when you look at it, those days have come down to just 3 days versus 148 days. So improvement in terms of that operational performance improvement is coming in, and operational efficiency is coming in as well. And cash flows, operating cash flows have seen a good improvement there. 3,670 crores in September versus 150 crores last year. So good performance all in all. We'll see green on the stock for the day.
Okay, all right. Thanks a lot for that, Vinny. Hopping across to Ria, who's here to tell us about some other stocks that are in the news. Hey, Ria, morning.
Good morning, Nigel. Let's start off with Tilak Nagar Industries. The company will be in focus since the promoters have pledged 26% of equity and 9.3 lakh shares have been allotted to the promoter on a warrant conversion basis. And the amount for this is aggregating to roughly 26.6 crores. Cello World will also be in focus after the company has entered into an agreement to assign its trademark for Cello brand for the stationery and writing instrument segment of the company from CPIW on a zero royalty basis. Now, as a result of this, the company is also eyeing a revenue of rupees 200 crores over the next 1 year in the first 1 year of operations starting in January of 2026, and this is with an investment of rupees 50 crores. Also, keep your eye out on Eris Life Sciences. The company has bought the remaining 30% stake in Swiss Parenterals for roughly rupees 423 crores on a preferential basis. Also, keep your eye out on Premier Explosives. The company has received an export order worth rupees 73 crores for the supply of defense products, and this is to be delivered within the next 12 months. Moving on to Dr. Reddy's, which will be in focus after the company has received an approval from the European Commission for a drug that is used to treat osteoporosis. The last stock that we're keeping an eye out on is Sunteck Realty. The company has marked its entry into the UAE with a luxury project with a GDV of roughly rupees 12,000 crores, and they also have a pipeline over the next 3 years. This is an ultra luxury pipeline which is exceeding roughly rupees 36,000 crores.
No, absolutely. Thanks very much, Ria, for that. Just one more bit of news, right? And this is a setback for and we're talking about pharma there, basically. Novo Nordisk, and they were conducting trials for using GLP-1 semaglutide to treat, to try and see if it has an effect on Alzheimer's. And last night, they abandoned those tests. Basically, that's saying that virtually there is no effect on, GLP-1 to treat Alzheimer's. I mean, if you think about drug categories, the next big drug categories, which are going to be, which are for virtually there is no cure, it's going to be things in the area of dementia, Alzheimer's, etc., etc. So that perhaps a bit of a setback. These drugs have been labeled by some as wonder drugs, a range of possibilities, but at least this one big thing last night, a bit of a setback. Okay, well, Manisha is here with a roundup of everything which is happening in the commodities space. Manisha, good morning.
Morning, and thank you for that, Prashant. I'll start with the crude oil prices, and the prospects of Russia-Ukraine peace deal seem to be getting closer now. U.S. had earlier proposed a 28-point peace plan aimed at ending the Ukraine war. Now, that has been cut to a 19-point thing with consultation with various European leaders there. So the deal, if that goes through, could ease sanctions on Russia, and that is what is weighing onto the crude oil prices, which, by the way, in this year now have declined by 19%. The strength, though, continues in case of the metal prices, and this is ahead of the U.S. data. You remember, we have the retail sales numbers coming in today, the jobless numbers coming tomorrow. And ahead of that, there is some strength in the weakness in US dollar and strength coming in for gold and silver both. So gold is above 41.50, silver trading above $51 an ounce. And that's exactly what we are looking at in metals as well. The steel rebar futures are trading at a 1-month highs. Copper prices trading up to nearly 2-week highs as well. So metals as a sector continues to shine ahead of that US data.
Thank you very much for that. But for more stocks and ideas, let's go across to Sudarshan, who will fill us in with the brokerage calls of the day. Sudarshan.
So Investec has written on oil marketing companies, and it has downgraded all the 3 names, IOC, BPCL and HPCL, to sell from hold. For BPCL, target is rupees 330, for IOC, target is 145, and for HPCL, target is 425. And the reason is it's saying that market seems to be overlooking the fall in diesel marketing margin that these companies are facing. It says investor interest in oil marketing companies surged alongside sharp rise in the refining margin. Singapore GRMs doubled in less than 2 months to $13 per BBL, but OMC's profitability is more sensitive to marketing margin rather than refining margin. And diesel cracks that are lifting refining margin have dragged diesel margin, and diesel margin in the last few days has slipped to negative territory from the level of around rupees 4 per litre a month ago. And if the diesel cracks remain elevated, it would have an impact on the earnings of all these 3 companies. JP Morgan has it on Reliance Industries. It maintains overweight call and target is 1,727 per share. It says Reliance is up 27% year to date, and it has outperformed Nifty, which is up 17%. But it maintains positive bias going into 2026. And it has given 3 reasons. First, valuations relative to peers, and peers here are DMart and Bharti Airtel, are still attractive. Second, RIL still trades at a 15% holding code discount to peers, and earnings drag from weak refining of petchem through FY 24-25 is over as per JP Morgan, and it should improve further going ahead. Current refining strength has potential to drive upgrades and likely catalyst for 2026. First, Geo IPO and tariff increase that is expected. Second, new energy commissioning, and last one is more stable retail growth.
Okay, all right. Thanks a lot for that, Sid. Well, time to slip into a short break. Up next, we'll have Parag Thakkar of Fort Capital for some fundamental stock talk. Later on, we'll also be joined by Elara Capital's Karan Rai to discuss the impact of the labour law on platform companies. Welcome back. You're tuned in to Bazaar Morning Call here on CNBC-TV18. As promised, let's welcome Parag Thakkar, Senior Fund Manager at Fort Capital, who joins us on the show. Hi, Parag. Good morning. Good to see you. Parag, we were just discussing about the Nifty IT index making a big comeback. Year to date, it's an underperformer. You compare it with the Nifty. You compare it with the NASDAQ as well. But the last 1 month, actually, the boys have shown up. The tech boys, they are feeling it, and yesterday at Motilal Oswal that went ahead and upgraded the stocks as well. From this pack, what do you prefer? If you could name 2 stocks from the IT pack that you like.
So basically, I am equal weight in IT right now in my portfolio, and with large weights on Infosys, Tech Mahindra, and Mphasis. These are the 3 stocks in my portfolio, and I'm overweight, equal weight, but Infosys I'm overweight. Basically, you cannot ignore this cash flow generating companies for long. My view is that Infosys generates a free cash flow of around 35,000 crores. Right? Market cap is 630,000 crores. And they pay you 90 to 95% of that free cash flow as dividend or buyback. I would say 18,000 crore buyback is going on, right? So I would say that 5%, 4.5 to 5% dividend yield, 5 to 6% free cash flow yield. And you are looking at now an increasing probability of December rate cut in US, plus signing of trade deals with China is also progressing well. Hopefully, keeping fingers crossed, it will happen with India soon. So I would say that the valuation in this particular space was very attractive. These are high free cash flow generating companies. So I would say that this is not a valuation at which you will go underweight in these companies.
Okay, all right. You'll not want to go underweight, and Infosys is the one that you like.
Infosys, Tech Mahindra,
Mphasis. Got it. All those 3 stocks.
Now, see Tech Mahindra's CEO's comments on the Mahindra Investor Day.
Yeah,
they are very interesting. Yeah, he said that till FY27, their target is to get to that 15% EBIT margin, which he has promised to the street when he joined. Then after that, he said that the growth will be supersonic. Now, how growth will be supersonic in IT? That is because of this AI thing getting translated into revenues. That means he's expecting that from FY27 onwards, going into FY28, these AI deals, right now also the deal wins are very good, right? We are not seeing ramp up of those deals because everybody is in wait and watch mode in US. So once you see the AI deals getting larger and they are getting reflected in revenues, which is after FY27, then you will see growth also in this space. So it is just a matter of time. You have to buy at right value and wait for growth to come.
Yeah. Parag, hi, morning.
Good morning.
I'll just segue from what you left off at Tech Mahindra, but with Mahindra specifically. My colleague Shireen spoke with all the business heads and CEOs across the Mahindra groups. Big targets, right? In terms of 5 years, there was something on M&M and M&M Finance and so on and so forth. Leave Mahindra and Mahindra, the auto business aside. Anything else out of that on the back of what you heard at that investor conference and at the interview, which you would like to get behind?
No, I would like to say that Mr. Anish has done wonders for the group, right? Of course, the entire team deserves credit for that. The way they launched SUVs one after the other and got a huge success. Yeah. And they got a tailwind from tractor business also. And plus their ambition for the other growth companies like Mahindra Lifespace, Mahindra Holidays is very encouraging, and they are ready to support these companies financially or capital-wise. Any perspective, they are able to. They are most capable and they are willing to support all these subsidiaries also. So I would say that as of now, out of them, I have Tech Mahindra in my portfolio, but definitely Mahindra Lifespace and Mahindra Holidays are something to consider. They are right now small companies. They can become big. They have all the right to win and huge support from parent.
Huge support from parent as well. Got that. I mean, your call on Piramal Finance has worked out. I mean, it's a great run, right?
By God's grace, luckily, yeah, it worked out very well, and all credit goes to management, Mr. Jairam and his team.
He was on with us yesterday with Lata at 10:15.
I missed that.
Yeah, you can find it on YouTube. I mean, the interview. It was more the sector, but of course a little bit about the company as well. But if you've looked at the numbers and updated it as of yesterday, where does it stand valuation-wise and I mean the upside-wise from here? You think it's basically it came at about 12.50, right? And now I'm not sure where it left off yesterday. Closer to 17.
I tell you, I was on your conclave, and when it was about to list as Piramal Finance, the last closing price was 1124.
Wow. Yeah.
Today we are at 1590, so it is up by 35% from your CNBC conclave day. Yes, their stock has done beautifully. No regrets. Very happy about it.
No, why regret? It's done very well. I'm just.
But I would like to say that when a stock does so much well, it can take a break also. So I would not thumb the table and say that a new investor should buy at this price. One should wait for consolidation.
Right. Parag, stay with us and we'll ask you about Swiggy, Eternal, Zomato, etc. as well. And we want to just get in a specialist on it. Karan Torani is with us.
Indeed, Karan Torani of Elara Capital is also now joining in. He's the Executive Vice President. Karan, thank you very much for joining in. Now, you've had about 48 hours to assess all the changes in the Labour Code. They're simplified, consolidated. But in the near term, there could be an overhang or some cost implications for gig economy workers, Swiggy, Eternal. Going by the stock price yesterday, it didn't look material because stocks recovered, closed pretty much flat. But take us through your assessment, and are there any changes to your EPS estimates basis this?
Hi, Ima. So firstly, I think in terms of this impact, this will have a negative impact in terms of the cost for the food tech and the quick commerce companies, because gig workers is a very important segment in terms of the last mile delivery for them. Look at it here, I think there is a negative impact of anywhere in the range of 30 to 50 pips as a percentage of GOV. And on a per order basis, this number is around 2.5 to 3 rupees on a per order basis. So I think most of these companies are already providing benefits to the tune of medical insurance and some bit of maternity benefits as well, which is around maybe 1% of the top line or closer to that. This could potentially move higher to 2% of the top line. Now, the code clearly says that it has to be either 2% of revenue up to 5% of gig worker payout. So even if you put a scenario here that it is up to 5% of gig worker payout, even basis that, the worst case impact is not more than 2.5 rupees on a per order basis. The impact in terms of numbers is about 250 crores on EBITDA for both these companies on an average roughly. In terms of the negative impact on the margins, we don't see a big material impact of the medium to long-term perspective because as your revenue scales up, this impact will kind of become smaller with time. And secondly, I think we do see a potential that this will eventually be passed on to the consumers. So I think if you look at the AOV here, on the food side, the AOV is 450 rupees. On the QC business, the AOV is 600 rupees. As a percentage of AOV, the 3 rupees number, which is a negative impact, it's a very small component. So we don't foresee a big negative impact even in terms of this impact being passed on to the consumers or if they are asked to pay for these kind of charges incrementally.
All right. Hi, Karan. Good to see you, Ben. So you're saying that 3 rupees will be adequate to push through any kind of hit, right?
Yes, absolutely.
All right. And both the stocks, if I look at Swiggy as well as Eternal, they've come off a good deal from the top. And yesterday, in fact, Swiggy started off in the red, but then we saw a sharp recovery. You think the stocks are at good levels to buy?
Yes, I think the worst seems to be largely over as far as Swiggy and Zomato are concerned in terms of valuations. If you look at Zepto's recent fundraise, if we assume a 50% CAGR in terms of their GMV and the fundraise that they have done, it's about 0.6 to 0.7 times market cap to GMV. Now, if you look at Eternal, if you assign a 50 times EV/EBITDA to the food business, which could be debatable, but we do see a premium multiple there because the business is duopolistic in nature. You are seeing better growth prospects, and EBITDA margin improvement is also there from here on. So assuming that, and then assuming the cash balance, and assuming the other business valuations, which is the Hyperpure and the events business, you are getting a quick commerce business today, the Blinkit, at about 0.6 times market cap to GMV, which is similar to the likes of Zepto. Now, because Blinkit is better in terms of growth rates, better in terms of scale, better in terms of profitability, we do see Blinkit trading at least at a 50% premium valuation as compared to Zepto's last fundraise. So basis that, potentially, if Blinkit has about 60% valuation contribution in terms of SOTP for Eternal, you see a straight 30% upside from here on. So I think the worst seems to be over in terms of valuations basis this at current price point. Second thing to look at here is the discount, right? The price wars. So the kind of price wars we saw in the month of Feb at the start of the year in CY25, with Zepto coming in aggressively in the market, we don't see those kind of price wars herein. I think most of these companies are now going to try to focus on profitability, and Zepto also will eventually want to go for IPO. And Swiggy's recent QIP is more for moving away from 3P to 1P in terms of inventory model in the QC side, for reducing the foreign investment, and not because of price war discounting. Another important point is many of these companies like Amazon, Flipkart, which are making foray in the QC side, are not looking for price wars, but they're betting on execution rather. So I think if price wars is behind us in terms of worst, we don't see increase in terms of losses for these companies here on, unless you see a lower throughput per store in terms of the expansion that they're doing right now. The non-metro markets today have got lower throughput per store. So if that has a negative impact on the profitability, that could be a case in point. But external forces or price wars are behind us largely.
Okay, all right. Before we let you go, you're bullish on both these two names with a substantial target price, which is 25 to 30% higher than current prices, I think, on both of them. I think on Eternal, it's around 415 rupees. What are your other picks? You track a whole host of stocks. If you could name a couple of them.
So in terms of other picks, we are currently liking Jubilant FoodWorks. I think we mirror this company to food tech companies. I think we do see strong growth for Jubilant FoodWorks because of LFL SSG traction coming, and they are the only QSR player which is reporting growth. Obviously, LFL growth rate will converge because of a high base over the last 4 to 5 quarters. But on a steady state, we do see LFL growth rate of 5 to 6% and store growth of about 8 to 9%. We do see margin expansion as well playing out. Other QSR companies are reporting a lower margin. The margins are coming off because of price war. In pizza as a category, the competitive intensity is the worst seems to be behind us.
Okay.
The competitors are either scaling down or not expanding aggressively. So that could have a positive impact in terms of their margins as well. So I think Jubilant FoodWorks we like as a top pick apart from Eternal and Swiggy as of now.
And any view on the Restaurant Brands Asia? My colleague Vivek and I think Mangalam, they were working on a story yesterday which we had filed that the P could possibly looking at exiting. Any view on that name?
Yes, we do cover the stock. We have a buy rating on the stock as well. I think Restaurant Brand Asia, the India business, has done reasonably well as far as growth rates are concerned. They have consistently delivered a better SSG, positive SSG as compared to peers. And even the store growth has been good from their end. The problem from their end is margins in the India business, which is quite low because they've been going for a price war. But as the growth rate picks up, as operating leverage does pick up, we see margin improvement as well. The key monitorable for that business in terms of rating or valuation multiple for the overall business will be what happens to the Indonesia business. Indonesia business is currently making losses, and they've tried to scale down in the last 4 to 5 quarters. But once we see a potential exit or we see Indonesia business going to a break-even point is what will trigger re-rating for this stock.
Okay, got that, Karan. Out of time. Thank you very much for joining us with that precise commentary on how you think about the labor law impact on platform companies and, of course, your thoughts on other names under your coverage as well. We'll take a quick commercial break here. Parag is with us, but we'll also connect with Sudarshan and Mitesh for some technical trading ideas. Stay tuned, coming up.
Welcome back. Hope you're having a good morning. Well, as promised, it's that part of the show when Hormuz joins us to tell us all the big movers yesterday, and some of them were backed with delivery. Hey, Armas, morning.
Good morning, Nigel. And mostly the broader markets were sulking in yesterday's trading session. So start off with a segment that was leading those losses. Real estate was one of them. And Anant Raj saw some sharp moves to the downside in yesterday's trading session. It was a top loser on the realty index, has now declined in 4 out of the last 5 trading sessions. You look at the volumes as well. 30 lakh shares were traded. The volumes were around 20-day average of around 20 lakh shares. And out of those 30 lakh shares, 13 lakh shares were marked for delivery. Here too, the 20-day average is around 7 lakh shares. And the stock has not had a very good year. It's down almost a third in 2025 and 40% now from its 52-week high. So Anant Raj was one, but the ones that were bucking the trend yesterday were IT, and even those stocks came off the highs of the day. But Tech Mahindra managed to hold on to gains of around about 2.5% among the top nifty gainers as well. The Monday's volumes were the highest in 5 months for Tech Mahindra, with close to 70 lakh shares were traded. The 20-day average was around 20 lakh shares, and out of those, so it's a significant delivery-based buying here, because out of the close to 70 lakh shares, 36 lakh shares were marked for delivery. So over 50% of the shares traded were marked for delivery here, and the stock has, in line with other IT names, is still down around 17% in 2025. And the stock on the downside yesterday was Tarson's Products among the small cap names. The stock is down for 14 straight sessions now. Even yesterday, the stock was down around 8.5%. And in the month of November, it has declined in all but one session. The 3rd of November, the stock ended marginally higher. Ever since then, the stock has been on a downward move. It's down around 30% in the last 14 sessions. Yesterday, 10 lakh shares were traded. The 20-day average is just 1 lakh. And out of those 10 lakh shares, close to 6 lakh shares were marked for delivery. Here, the 20-day average is only 65,500. So 10x in comparison to the delivery volumes as well. The stock has halved in 2025 and is down well over 70% from its IPO price, which was around 660 rupees. And lastly, ITI, the PSU names that were on the downside yesterday, this one was bucking the trend. Had a very good session, close to 10% higher, snapped a 6-day losing streak yesterday. Volumes were the highest in 3 months, close to 3.5 crore shares were traded. The 20-day average is only 5.5 lakh, but out of those 3.5 crore shares, only 16.5 lakh shares were marked for delivery compared to the 20-day average of just 1.5 lakh. Of course, a low free float, government has 90% stake, and the stock has been an underperformer, down 16% so far.
Yeah, thanks very much, Armas. Very interesting stuff there. As always. Parag Thakur is still with us. Parag, thanks for waiting. The mid-tier banking space, and we talked about Pyramid Finance and some of the other stuff earlier. I think you're bullish on, Nigel was telling us, Federal Bank?
Federal Bank
is that the top idea out of that space, that category of stocks?
Yeah. So we had City Union Bank. Luckily, City Union Bank did very well for us. And now we are overweight on Federal Bank. We have a 4.5% weight. And we like Mr. Manian's strategy, which was demonstrated in this quarter very well, where actually margins were supposed to decline, but they expanded margins by focusing on CA, current account, and fees. And plus, they are now lending to mid-yielding segments where risk-reward is favorable. So I would back that strategy. And I feel that the bank's DNA was always very good. They were a very conservative bank, lending to SME and retail. They never take disproportionate risks, lending to microfinance for high yields and all that. So we would love to back Mr. Manian's strategy, and we would be a long-term investor in this company.
Okay, all right. Federal Bank is something that you do like. One stock that's actually caught everyone's attention in terms of volume moves has been Karnataka Bank. Massive move is what we're seeing out there. Volumes extremely high. So let's see whether or not there is something that the street is getting right on this one. But in the last few trading sessions in a wobbly market, it's done 172 around 200. Yesterday's high, I think, was 205 or thereabouts. But Parag likes Federal Bank. Parag, final question before we let you go. Now, the Nifty has been doing okay. It's holding closer to around the all-time highs. And that's because the big boy Reliance Industries has got a couple of triggers. Going through a Jefferies note as well, they are fairly bullish on the stock. I think from a market perspective, where Reliance performs, it helps the Nifty because of its weightage. What's your view?
So Reliance is my largest holding as of now in the portfolio. Reliance, SBI, as I said, Federal, Infosys, L&T. These are my largest holdings. The simple way to look at Reliance is this: that market cap is close to around 20.5 lakh crores. And I would say that Jio is a fantastic business. You imagine 50 crore subscribers, using 24/7 all the way, and that revenue goes to Reliance, and Reliance make 50-55% EBITDA margin out of it. So I think the street is valuing Reliance Jio at around 585 rupees per share after Holdco discount. I think it should be much more. First of all. Second, retail. Q2 itself, retail showed 16% YOY growth. I'm expecting better growth in Q3. So these two consumer business, which make 1,05,000 crore EBITDA in total, it should get higher value in case of Jio and should do well from earning perspective in terms of retail. So I would say that if I sum up, and plus the new energy business is starting, 40 gigawatt factory is starting next year. So that will get, say, 150 rupees per share value. If I add it up, I think whatever these brokerages are suggesting, above 1,700 rupees should be your minimum intrinsic value of the company. I would not say target price, intrinsic value of the company. Target price depends on what they do afterwards also, right? Because Reliance is a box from where the value unlocking keeps happening. And plus net debt to EBITDA is in control, which is a major thing. If all businesses are incubated, grown with very, very calibrated debt, which is the most important thing, right? So net debt to EBITDA is below 1x.
Parag, thank you very much for joining in. Point taken on Reliance. Big mover, 27% up on a year-to-date basis, outperforming the Nifty by nearly 10%. Get into a break. On the other side, we'll come back with the pre-opening rates. We'll also be joined by Equirus Capital's Vijay Agarwal to discuss the labour law effect on the infrastructure sector. Welcome back. Let's get in our technical experts to assess the way trade will play out today. Sudarshan Sukhani and Mitesh Thakkar are joining in. Good morning, gentlemen. Good to have you this Tuesday morning. Sudarshan, let me start with you. Your thoughts on the Nifty Bank. Quite a bit of a fall in the last 1 hour yesterday.
Yeah, good morning. Yes, yesterday was a disappointment, especially the second half, as you say. Well, the trend is, I would say the trend is up, but that doesn't feel like that. Our stops for the Nifty are 25,800. With that stop in mind, you have to maintain, I would suggest maintaining long positions in the market. There's no need to buy today. If you have a position, hold on to it. I've already given you a stop loss. Let this choppiness be over. Then we'll take new trades, but existing long positions hold.
Okay, so stop loss should be 25,800. Mitesh, you've been a bit cautious in the markets. Yesterday, in the last 30 minutes, you were recommending a few STBT calls. What's the outlook today?
In fact, yesterday morning also I suggested that we might be in a range, and therefore we might actually, after getting close to the all-time highs, see some kind of a pullback. And would just still maintain that outline that the good area or the good levels to buy would be closer to about 25,900, 800 zone. I think somewhere between that 100-point range. So I still believe that that's the good buying opportunity. But one thing which has changed from yesterday is the PCR, which is now close to about 0.65, 0.66, I think, and getting close to oversold levels. So I think today, in that sense, if we get a 50, 70 point kind of a cut, I think, we'll be in that buying range, and I would explore some long ideas. So on the index, if you get it around 25,850, 860, buy with a stop below 25,780, and look for a retest of 26,100 to about 200 zones on the upside. So that's the idea.
By the dip. What about stocks, Mitesh?
So on the stock side, I have 3 buys to a sell. Wipro, after a long time, comes on the buy list. Keep a stop at 243. Look for a target of 255. RBL Bank, after a good pullback, has come to support level. So buy with a stop at 303 for targets of 318. And MFSL, I think that's also a buy. Keep a stop at 1650. Look for targets of 1740. And one sell call, that is PNB Housing. On a mild bounce back, say around 876, 880. Sell with a stop at 895 for a target of around 840.
Sudarshan, your calls?
Well, it's a mixed bag, and that tells you that the sense is not very clear. RVNL is a buy with a stop under 322. Persistent is a buy with a stop under 62.40. Now I have 2 intraday shorts, Ashok Leyland buy with a stop above 150 and Glenmark. And Ashok Leyland, sell with a stop above 150 and Glenmark, sell with a stop above 1870.
Kavda, we'll come back to you and revisit the trades. For now, the big story over the weekend and yesterday was India's new labour law regime. So 29 laws have been rationalised into 4 new labour codes. And the aim is to modernise the framework, extend social security to a wider workforce, formalise the workforce and ensure universal wage protection. Labour Secretary Varindana Gurnani told us that a committee would be formed to fix the floor rate soon. Listen in.
Floor wage was there earlier also. However, it was not mandatory. It was an optional kind of a floor wage which Government of India used to fix at regular intervals. Now, as per the new course, the floor wage is going to be having a statutory backing, which means it's mandatory and no state should fix their minimum wage below the floor wage. The floor wage would, as you said, look into the minimum living standards, and there would be a committee of experts that would be deciding on what should be the floor wage, and these would be periodically revised upwards. A lot of factories would have slightly less than 100 workers directly employed and rest through contractors, so that they could not come in the ambit of this condition. Now this has been increased to 300, so which means that up to 300 the companies would be now encouraged to take people on direct roles with themselves instead of taking them through contract, because it's only above 300 that they would need to take permission for any retrenchment, layoff or closure from the government. So this, in a way, this actually increases or encourages formalization, and this is an aspect that needs to be understood more clearly.
Indeed, even the experts we spoke to yesterday, they're saying that this is one big step towards formalization of the Indian workforce. We've been talking about it for long, but the labour laws will truly ensure that. So that's a big push towards that. But let's talk about the infrastructure sector, also a very labour-intensive sector. So let's find out how these changes will impact the profitability of companies listed here. Vijay Agarwal, MD and Head of Infrastructure Practice at Equirus Capital, is now joining in. Mr. Agarwal, morning. This is Reema here. First, give us, the impact as you see it of the proposed changes in the labour code.
Thanks, Reema, for inviting. See, these labour codes are a very progressive steps in the country, and we were all waiting for last 5 years where the laws have been passed, but they were not operationalized. Now, definitely every sector will have a mixed bag. So infrastructure sector is a very labor-intensive sector, and you have laborers which are on the payroll of the company and which are outside the payroll, because you require thousands of labor to carry out the work. Their job requirement may be for 6 months to 1 year, and typically people move from site to site to do the work. But with the new amendment, I am not the expert, but whatever I had read, see, there are two things which will have a profitability impact on the infra companies. One is your minimum wage, where the PF is applicable. It has been increased from 15,000 to 25,000. And another changes which has been done is that your allowances are also covered now for PF deduction. So that will have an impact on the profitability. It will increase the cost. Another one which was the gratuity. Earlier, you had a 5 years period required for a payment of gratuity. Now, it has been reduced to 1 year. So, generally, what I had seen in the infrastructure industry, people stay for 3 to 4 years in one company, then move out. Now, this will definitely increase the cost of gratuity, because if any person is staying more than 1 year, the company has to pay a gratuity. By the way, if you see local municipal laws in the offices, as per shop and establishment, gratuity is payable after 1 year. But definitely it was not applicable to the factories and other setups. So I think that's a parity government has brought in here. I think the similar amendment will be required in income tax to give the exemption for gratuity. So I think on the labor side also, once you are paying the wages to the laborers, And generally 18 to 20,000 are the wages which you are paying to laborers as a minimum wages across India. So now you will have to pay a PF on this 20,000 amount, not on 15,000 amount. So there will be some impact on the companies. We have to see how it will pan out for all the companies.
How do you think this increased cost burden will be shared? Have you spoken to any companies or done any sensitivity analysis? Which companies do you look at in the infrastructure space, and how is their cost structure changing post these? Have you done some numbers?
Yeah. So generally, ballpark number 6 to 8% is the employee cost in most of the infra companies.
Okay.
And maybe I think maybe a 0.2% impact may come for these companies because of these changes.
Sorry, 6 to 8% is the employee cost as a percentage of overall expense, and the increase will be?
0.2 to 0.3%, not more than that. I don't see it will be a major impact of that. But see, they were already complying up to 15,000 rupees.
Correct.
It's a 15 to 25,000, which is an additional impact they had to bear.
Okay, got that.
And
this they will have to bear, or do you think the clauses that they have allows a pass-through?
I don't think labor is a component which is a pass-through.
Okay.
In the contracts. As per my memory, whatever contracts I had read, labor component generally see your WPI is a one pass-through where WPI inflation index, and they link to a major raw materials basically. Rest of the cost is a fixed cost for the companies basically.
Okay, so
this will be part of the fixed cost.
Fixed cost. So increased wages, PF, gratuity will not be a pass-through, according to you, but the impact is about 0.1 to 0.2%. You also spoke about how these companies employ a lot of contract laborers who move from project to project. So what happens to this floating workforce, and is there going to be any change? Do you think companies will now, these contract laborers will prefer to be associated with one company? How does it change the dynamics?
So I think dynamics will not change. Currently also the laborers who are on the contractor's payroll, their PF compliance is being done regularly. So it will continue, and I think the PF Act has made a very good thing is where they had given a single social security number to each laborer. So even if he moves from one contractor to another contractor, his PF deduction is accumulated in one account, which he can withdraw at the time of his retirement. So his benefits are with him. And even if he is moving pan-India, the benefits are with him and he is able to access those benefits. And another, I am not sure about the ESIC. What I read was that ESIC will also be extended to these people, then they will definitely get the health benefits if it is so.
Okay. Vijay, just one final question. Just review the overall Q2 numbers for the infra companies that you track. What stood out for you in terms of trends? What are you watching going ahead, and your top picks?
So I think if I see the road companies, definitely order book is a big challenge, and that's why that is also being impacted on their growth. So most of the companies are guiding for 5 to 10% revenue growth in this year. And we have to really watch how many companies will able to meet those guidance. But see, everyone is already impacted because of order book. Order book is like 1.8 to 2.2 times of revenue. And probably if they don't get the order, next year it will be only 1x. And that is visible on the share prices of infra companies. And the last 1 year, roughly, there's a lot of correction, which is like counter to counter. It is some counter, it has gone to like 15%, 20%. Is because of that revenue visibility and profitability. But good thing is that these infra companies are diversifying their sectors. They are entering into solar EPC, BESS project, railway projects, mining projects to maintain their order book. If you see this 1.8 to 2 times order book, it's also coming from that perspective. So, yeah, companies are doing hard work to really...
We'll leave it, Vijay, we'll leave it there. Thank you very much for joining us. Good perspective. Just sort of apologies, we're just running into market open. So thank you for joining us with that perspective. Now, 9-10 calls a little later, actually, but Sudarshan is with us with that. Sudarshan, what do you have?
So Investec has downgraded all the OMCs, that is oil marketing companies.
So 1 minute. So that question was for Sudarshan Sukhani. I think Sud.
All right.
That's a nice one. Cross connection, huh? But I'm coming to you, Sud. Sudarshan, go on. 9, 10,
Persistent is a buying opportunity. Buy Persistent with a stop under 62.40.
Okay, Persistent. Mitesh, what about you?
I'll also go with the buy call today. A buy on Wipro with a stop at 243 for targets of 255.
Okay, 2 IT names, and IT did well yesterday. Thank you very much, gentlemen. Sudarshan, Sud, over to you. Ab boliye.
Okay, now to oil marketing companies. Investec has downgraded all the 3 names to sell from hold, and the main reason, main risk is the fall in the diesel marketing margin. While refining margin has moved higher, Singapore GRM has moved higher to $13 per BBL in last few days. But it believes that for OMCs, these OMCs are more sensitive to marketing margin rather than refining margin. And diesel marketing margin has slipped to negative territory from the around rupees 4 per litre a month ago, and that's the main reason that it has downgraded. Next one is JP Morgan Reliance. It maintains overhead call and target is 1727 per share. It says it has outperformed Nifty Y2D, but going into 2026, it maintains the positive bias because valuations relative to peers, those peers are DMart and Bharti Airtel, are still attractive. And earnings drag from weak refining and petchem through FY 24-25 are over. Some of the catalysts it has mentioned: Geo IPO and tariff increase, new energy commissioning, and more stable retail growth. That's it's expecting in 2026.
Got that. So right on time. Thank you very much for joining us with that. So OMC is down, Reliance up. That's the view. One from Investec, the other one from JP Morgan. Markets have opened, so it's absolutely flat. 25,970, 25,980. Nifty Bank is absolutely flat. And 58,780 is where. So it's kind of, almost unchanged, right, across the indices right now. Small cap index is a little bit more in terms of green. The mid cap index is slightly lower, so neither here nor there. This is an absolutely quiet start to the trading session. 900 up, 800 lower. So even in terms of, if you look at advanced decline, and this is very early to do that, there's not very much which one can kind of say one way or the other. Max Health on one side. I think with Max as well, there's a call from one of the brokers. BEL is there, JSW Steel, so they're all green. And on the other end of the spectrum, there's Indigo, Wipro, Nestle, but split right down the middle on the Nifty heat map. 24 points lower at this stage, 25,940 on the index. Guys.
Well, let's talk about Max Healthcare, where Citi has written a note where bullish call 1460 is the target price, and the current market price is about 1165. Max Healthcare is up 1%, top gainer now on the Nifty. They met the management, that's Citi, and the key takeaway is that the management expects a strong growth trajectory supported by rising occupancy, improving case mix, improving profitability at Dwarka and Noida. And even the 3 major brownfield projects which are going to be commissioned, they don't expect an EBITDA drag from there. So Dr. Reddy's is doing pretty well. BEL has seen a pop this morning. The company has gotten into a joint venture agreement with another company, Safran Electronics, for production of Hammer Smart Precision Guided weapons. So joint venture agreement, BEL, has seen a bit of a pop. Other gainers included Dr. Reddy's. Dr. Reddy's today has surpassed the 200-day moving average with the gain today. The European Commission has granted marketing authorization for a medicine for Dr. Reddy's, which is used to treat osteoporosis. So news there, and stock is doing well. So the top 3 gainers are Dr. Reddy's, BEL, Max Healthcare. Other stocks on the gaining list include Maruti Suzuki, Bajaj Auto. Eternal is up close to about 0.5%. JSW has a little bit of a green tick. On the way down, IT is seeing a little bit of profit booking after yesterday's gains. So Wipro, Infosys, Tech Mahindra in the red. Nestle has a bit of a downtick. Reliance Industries, JP Morgan is bullish. They see the target price above 1700, but there is no rub-off this morning. Reliance Industries is a bit subdued. And let's just pull up some of these oil marketing companies to see if there is any impact of that Investec downgrade. BPCL, HPCL, IOC come up for you on your screen. 1% down.
Well, that's right. And in fact, the Nifty is down 25 points thereabouts. I think the Nifty has very strong support at around the 20 DMA. So in all probability, that doesn't get breached in today's trading session. But the breadth of the market is already negative. So that's a bit of a worry.
And by the end of today, if that can turn around, the bulls will feel very, very good because on a day-to-day basis, we have seen the number of stocks that are declining are outweighing the number of stocks that are advancing. Moving to individual stocks, ITI has given up some ground, fallen on decent volumes for the first few minutes, down 2%. RVNL is another one. I think yesterday in late trade, it did see a bit of a surge. That one's giving back some part of it. It is down close to under 1.5%. And Aztec, Aztec Life, I think we should get that stock up for you on the screen. It was down a little bit. It was down 3% actually, but that dip has got bought into. And on a day-to-day basis, I've been observing this on Aztec. The last 1 month, it is up close to around 35%. So that's a stock that, should be on your radar. Karnataka Bank, another one of those big movers. Large amount of the stake is with institutions. There are large HNIs as well that have it. And, on a day-to-day basis, volumes have been very, very high. That is up yet again, 2.5%. Grow, that's up close to around 3%. Remember, in yesterday's trading session, the stock slipped considerably from the highs. So that started off at least on the winning side. And I think Physicswala as well, there was some green to kickstart trade. So the Nifty is holding with mild green now, 10-15 points higher. However, the breadth of the market, that's important. And for the time being at least, number of stocks advancing are marginally outperforming the number of stocks declining.
Absolutely, Nigel. By the way, Grow at 157 rupees is the number one volume-led gainer by far. Huge volumes on it, and it's up about 3.5% at this stage. This is G1 over TND, right? 1%, but very large volumes. So keep an eye out on this one. Karnataka Bank, big outperformer. I mean, it just keeps going. So 2 days back, 175 close, 200 pass now. So that's the other thing. What else? Teamlease was this big shooting star, but Teamlease kind of ended in the middle of the range. The high yesterday was about 1872 and the close was 1686. But it's up 3% this morning. Premier Explosives 1.7 higher. There've been a couple of upgrades on these new listings, HDB and Tata Capital. HDB I can see with about 1.5% gain. LG Electronics, again, one of those names after listings which has not done very well. It's up about 1.5%. The Phoenix Limited, the mall company, 2% higher. And so it goes. But, you go down the list, volumes start to thin out very, very fast right away. Narayana Hrudayalaya, basically it's a big step up compared to where it was, 6-7 days back. From 1750 levels, it went up to about 2100 and it's cooled off to about 1940 right now. It's under pressure with some, not large, but it's got volumes on it. Swiggy is down another 2.5%. Swiggy is down, 2.5 odd percent at this stage. So, yeah, I mean, it's a quiet, very, very quiet. 1 point change on the Nifty, right? 25,955, so finely balanced almost. Well, we have Ashish Gupta, CIO at Axis AMC, is with us. Ashish, good morning. Great to have you with us here. Prashant this side. Thanks very much. As some people have jokingly described it, but I think the description fits accurately. This is a market in liquid oxygen. That old Ajit saying, "Jeene nahi dega, marne nahi dega." It's like there's enough on both sides, right?
I agree with the sentiment. I think if you look technically on the market, you have the macros that support it. I think we are also seeing a fair degree of resilience in earnings. I think this quarter, after nearly 5 quarters, we have kind of stepped away from the earnings downgrades that we had been witnessing. So I think the macros support the market, domestic flows support the market. But on the flip side, we continue to have the challenge with the large pipeline of IPOs and stake sales, right? And if you look at the data, just in the last 90 days, more than 60,000 crores of IPOs have happened. Over the next 1 month itself, another 30,000 crores of IPOs are slated to come to the market. So I think the fact that domestic flows and SIP flows continue to be strong is offset by this continuous supply that we are seeing. And again, IPOs is only one part of the supply. And if you see some of the data about non-IPO supply. So, for example, companies that had IPO'd in the last 6 months, about $30 billion of stakes will be getting out of lock-in over the next 6 months. So unfortunately, this pipeline of supply does not seem to be abating anytime soon, and that kind of keeps the market upside more moderate.
I think sometime this week we'll hear more on Misho's IPO too. Perhaps the price man and then the opening would subsequently follow. And that's going to be a big one, keenly tracked. Ashish, morning. This is Rima here. So as you look ahead to 2026, what are the big predictions that you are making? What do you expect? India's performance relative to global peers, will it reverse the underperformance? I mean, what are your thoughts about next year? And give us your top 3 predictions.
Sure. So I think clearly this year, thankfully, on absolute basis, India has not done too badly. We are still up a high single-digit percentage, particularly in the Nifty. The broader market, the small caps may not have done as well. But I think it's not been a bad year for the overall market. We'll end the year on a positive note. Where we kind of have struggled is on a relative basis. This has been a year of global equity market rally, particularly with the dollar weakness in the beginning of the year. Many global markets have been up in dollar terms between 25 to 35%, and we have not participated in that. Looking at next year, I think we can be more confident in saying that relative underperformance should go away. I think the challenge will be what's the degree of absolute outperformance that we will have, because given where valuations are, given the magnitude of supply that is coming in, big gains in the market look unlikely. I think what is very positive for the market is that in the last 6 to 9 months, we have seen a lot more affirmative action from the regulators, RBI, SEBI, as well as the government. And I think really we, after the challenges we have had on the tariff front, there is much more the sense of urgency in the government to take action to support the economy. We have seen reforms on the GST side, more recently on the labor code. We are going to see in the next month and a half, the new insurance bill coming through the parliament. There are more capital market reforms that are on the anvil. And another big activity that is being undertaken is deregulation. So there is a committee headed by the cabinet secretary that's driving this. There are also several provisions around decriminalization of major laws that are coming through. So I think that is really what will continue to spur the economy over the next 6 months. And that makes us more optimistic that the earnings recovery that we are seeing should sustain into next year.
All right. Hi, Ashish. Good morning. Good to see you. And Nigel on this side. Ashish, I wanted to ask you about the RBI action. What's your take? December rate cut is something that the street was expecting. You suddenly had some weakness on Friday, on the Indian rupee, which, gave you a little bit of a jitter. But otherwise, inflation down. I think the CAD is at the lowest we've seen in multiple years. Do you think that a rate cut is in the offing? Would you be backing it?
Yes, I think definitely we are expecting a rate cut. I think, frankly, if the pressure on the currency would not have been there, I think the probability of even a 50 basis point rate cut would have been there. But I think 25 basis point rate cut probability in the December meeting continues to be high despite whatever recent volatility on the currency we have seen. I think where we need to kind of be watchful of really what is the RBI action on the liquidity front. And if some of the defense of the currency leads to some moderation in the liquidity surplus that has been there in the market. If we look over the last 3 months, unlike last year when RBI tried to defend the currency around 83, 84 levels, the intervention has not drained out liquidity, and that's meant that cost of funding has continued to drop. So I think that is the only piece that we need to watch out for, that even as rates come down, even as RBI kind of steps to curb the volatility in the currency, how does the liquidity environment pan out? The other piece is really in terms of the demand supply for the long duration bonds. I think while liquidity has come in through the CRR cut, this year the open market operations have been limited, and the demand supply of bonds therefore had not been as favorable, and that's the reason we haven't seen the drop in the 10-year yields commensurate with the magnitude of rate cuts that have happened. So I think these are the two points that we need to watch out in the policy statement. I think the market is fairly confident about the rate cut coming through.
Ashish, we've got a flash running attributed to you. Big gains in markets unlikely. But we need some gains. Where will those gains come from? Where, would you look to, would one have to venture into slightly more, for the lack of a better word, riskier areas of the market, more, focused on absolute returns, single stocks, and even within sectors which look like they're not going anywhere? So what's the strategy going to be at Axis?
So actually, we are seeing over the last quarter, earnings growth recover and coming back even in the large cap space. And if you see last 5-6 quarter, the gap between earnings growth between the mid cap and the large cap space had widened. A large cap earnings growth had come down to low single digit 5-6%. And as I look into the next year, you are actually seeing large cap earnings growth recover. It's recovering in financials. It's recovering in the energy sector. Most of the IT companies are also talking about revenue growth being better than the last 12 months. And we are actually seeing next year earnings growth moving to about 15 to 16%. If you would have seen 3 quarters ago, we were at about 6% earnings growth. This quarter, earnings growth for the market has recovered to 10%. But clearly, the large cap earnings growth is picking up, and it's broad-based. If I talk about sectors, of course, financials, both banks and NBFCs, we continue to like. Besides the liquidity, what we are seeing is some early signs of pickup in credit. Asset quality challenges have anyway been modest. We continue to like sectors like power, defense, where there is strong themes of indigenization also playing through. Consumer discretionary is another area we like. So there are multiple sectors to play. And I think it's going to be a better market than what we saw, say, beginning of this calendar year, where the gains were much narrower.
All right, Ashish, always a pleasure talking to you. Thanks a lot for joining in. Wishing you a good day ahead. And we catch up before the end of this calendar year. Thanks a lot for joining in. Well, let's turn our attention now to the ferrous space. And there's plenty happening, both on the domestic steel industry as well as on the global front, with China exports continuing to remain at elevated levels. How can our regulators, as well as the people at the center, protect the domestic steel industry? Well, to help us out with some clarity, we have Sandeep Pondrik, the Secretary, Ministry of Steel, who joins in. Hi, Mr. Pondrik. Good morning. Thanks a lot for joining in. Always good to have you on the show, sir. Now, Street is waiting to hear from you, sir. because there have been some jitters with regard to this protection that you all were offering to the ferrous industry. Case in point being the safeguard duty. You all put it in at the right time. Then there was that notification that said that it's going to be in the works. However, the safeguard duty lapsed earlier in November, and there were some jitters about the way ahead. Is it delayed, the final notification, or is there some rethink? And if there's no rethink, by when do we expect this final notification with regard to safeguard duty on steel?
So thank you first for having me on the show. And on the safeguard duty, as you know that there is a process which was conducted by DGTR. And on the recommendation of DGTR, the provisional duty was imposed, which was effective till early November, 6th, 7th November. After that, the provisional duty has lapsed. However, DGTR has also recommended a safeguard duty for 3 years, which is under consideration with the government. So we can expect a decision pretty soon. I can't give you a time frame right now, but I will expect a decision of the government in the near future.
All right.
That's the best I can tell you.
All right, so Mr. Pondrik, basically you're telling us that but currently is the safeguard duty already in works, that 12%?
No, after the provisional duty has elapsed, the safeguard duty is no longer there for the intervening period. If the government decides to reimpose it, means as per the DGTR final recommendations, then it will come into picture again.
But is there a risk, sir, that it doesn't, because in all probability, my interactions as well, whether I spoke to Tata Steel, JSW Steel, all of them indicated that it's coming. Just it could be a delay. It's not being put on the back burner. It's just a delay. Should we term it as a delay and we'll hear about it in the coming weeks?
As I said, the government decision should be there pretty soon. That's the best I can tell you. You know that since the matter is under examination in the government, I can't really give you a time frame or what the decision will be, but the decision should be there pretty soon.
Okay, we'll take it as pretty soon then, and the ferrous industry will be hoping sooner, not just soon, because otherwise we are at the risk of those imports coming in there. And the other point is, India relaxed the quality control regulations on steel imports. Why are we diluting BIS, sir? Do we have some kind of change in policy to facilitate maybe imports to help the SME players? Is there something on that front? I want to know the thought process.
So basically, before answering your question on quality control orders and BIS standards, I would like to point out the status of imports and exports.
Yes.
Now, if you actually see the import-export data vis-a-vis the data of the last year, the situation is much better in terms of trade imbalance as compared to last year. Last year, if you take the April to October data on steel exports and imports, last year the exports were less than half of imports, while this year they are more or less same. Imports are still slightly higher, but the situation is much better. Overall, the imports have reduced by 34%, and exports have increased by 25%. So just to give the background that in terms of trade imbalance in finished steel, the situation is much better than last year. Now coming to the issue of quality control orders and BIS standards. So there was a high-level committee made by the government which has recommended certain measures to ensure that the export competitiveness and the efficiency of domestic market is maintained. Now, when we talk about domestic market, it includes both the steel producers as well as the steel consumers. So the idea is that the domestic consumer industry also gets steel at a reasonable price, and they are not adversely affected. So that's why there have been decisions to relax some quality control orders on BIS standards for a specific time. So For some standards, we have relaxed, suspended the QCO for 3 years. For some, we have suspended the QCO for 1 year. It's also, for example, that in specialty steel, since we don't have production in certain grades, and specialty grades have to be imported, so we have suspended the QCO for a year. And we hope that the domestic capacity will come by that time. So it's basically to balance the interests of both steel industry and the consumer industry both.
Okay, you're trying to do that balancing act in there. And Mr. Pondrik, in the past, you have said that India's per capita of steel will just move up from here on. I think we're ballpark around 105 kgs or thereabouts. And you said that, we're likely to head to around 140, 150 as well. So how are you seeing demand on ground? The growth has been very good. Steel consumption growth in India actually has been splendid if you compare it with the globe. Do you expect demand to continue at this sort of a pace, 8-9% kind of growth? And also the government may go easy on the capex, right, in the second half of the fiscal. You have steel capacities coming on stream as well. And suddenly you have no big avenue to export because of what the United States has done and the way China is flooding the system. Do you fear that we're getting into a place where, in fact, that growth, that demand growth for steel could come in a bit of a tough spot? Or do you believe the demand is strong enough?
Well, if you see the data, for last 3 years, our domestic consumption has been growing at more than 12%, in fact, at 12.5%. This year, the consumption growth is slightly lower as compared to last 3 years. It is about 8% April to October data. But we expect the growth to increase a bit as it normally does in the second half of the year, because after the festival season, the infrastructure and real estate picks up. Having said that, I will expect that this year it's around 9%, the consumption growth. If we see the export market, you're right, there are challenges, especially in European Union, where CBAM will affect exports as well as the proposed European Union quota changes. That will also affect exports. If we take USA into picture, we did not have much exports to USA anyway. So that's not likely to affect us. Overall, the exports will come into challenge, but our expectation is that our domestic consumption itself, we expect it to, even if you take a 8 to 9% growth, it will be around 160 million ton. Domestic consumption, and our exports last year was only about 4.5 million tons. So exports do not make a large part of our overall production.
Okay.
Having said that, there is a short-term challenge that the capacities are coming faster than the consumption growth, because as you know, the consumption growth, even if it increases it to 9%, it will grow in a sort of a linear manner, while the capacities come in spurts. So we already have a capacity of about 215 million ton. So in short term, there may be some stress on demand-supply ratio, and we may have more supply than the demand for next 3 to 4 years. But I expect that the demand will catch up with supply as we move forward. So to answer your question in last one line, yes, I expect that the demand will continue to rise between 8 to 10%.
Mr. Pondrik, hi, good morning. Prashant here. There is, so let's just, 2025, I guess, has been such a volatile year, right? With tariffs and it's essentially has been very, very difficult to call, so many twists and turns. So as we go into 2026, maybe a lot of these hotspots will cool down. US, China, US, India, hopefully, very soon. And it'll be a more settled kind of a world. Maybe average tariff rates perhaps will be higher when they were where they were at the end of 2024, but more certain in that sense. Let's hope so. Once you have all this settled, do you think, generally speaking, as you said, steel is in India largely a local story. It's not so much, from our perspective, a big global story, provided we have that protection, etc., in place. But do you think once all these hotspots are settled and the environment is more certain, it should help in better prices? There's the China involution, anti-involution as well. And things should look much better in 26 over 25? It's a broad question.
Means to say that things should look up in terms of pricing. Yes, I think so, because two things. One, if you see the latest data from World Steel Association, the production of steel in other countries is going down. If you see the latest data, even China, the production in October has decreased significantly. So I would presume that the demand-supply scenario will improve. The steel prices right now are at quite low level. And as the demand increases in coming months, I would presume that 26, the prices would stabilize from where they are right now. And the steel sector should be, in terms of pricing and in terms of getting realistic or rather reasonable price realization, it should look better. And that is also reflected in the fact that the steel sector is planning and executing capacities, not only in the executing, but also in planning. So both is happening, and that sorts of gives focus on this thing, that even the market is looking at the thing that the demand will keep growing.
All right. Mr. Pondrek. And the building blocks have been in place. I think for the last 9 to 10 years, I've been seeing that every time the industry is in a bit of a tizzy, you'll come in there and you'll have helped the industry. And that's why we have a solid domestic ferrous sector, which is standing out in this volatile environment globally. And the point on China, yes, they're producing less. The problem is the exports are continuing at around that 10 million tons odd. Hopefully that cools off, because otherwise it's blocking avenues where we can export as well. But we'll talk about that in greater detail, in the next time around. For the timing, the market will want to know a couple of factors. What about NMDC Steel? Is there going to be a divestment? You said maybe, probably it'll happen. Timeline is not sure. Do you think there has been some movement on that front? And if you could help us out with RINL, how are things progressing out there? The turnaround strategy was in place. Progressing well?
So first, NSL, my answer remains the same. So the decision of divestment stands. The process is going on. There's no fixed time frame of when it will happen. So that's the status for now. Having said that, the plant is doing well. It is reaching almost 100% of its capacity in terms of production. Because of the low steel prices, they are not coming into a lot of profits, but in terms of operational efficiencies, they have improved quite significantly. So divestment, the decision stands. When, I can't really say. On the RINL, so as you know, last year this year, in fact, in January, government gave the package. They have used it well. I should say they have used it well from 25% capacity in August 2024. Now they are running at about 80% capacity. They should reach 100%, but there are challenges in terms they have never actually ran at 100% for a long time. So they are getting operational challenges, which they are trying to address. But we hope that now the plant is on its way for revival on a sustainable manner, not in a short term. So we expect that RINL will continue to perform well and do well.
Okay, all right, Mr. Pondrek. Always a pleasure, sir, having you on the show. As you're telling us, both those two assets are ramping up well, NMDC Steel as well as RINL. But I'll tell you what, a lot of industry players, as we speak, have already messaged. They are hoping that safeguard duty comes sooner than expected, because they have been waiting, for the past 1 month or so for that notification to come in.
Since we have Mr. Pondrek, absolutely unfair question to you, sir, but you're one of the top bureaucrats in the government. On this India-US trade deal front, you're shaking your head already. Yeah.
You better talk to my other colleagues who are dealing with it.
Okay.
I won't push you, but thank you very much for joining us, sir. Really appreciate it, and thank you very much. We'll take a quick commercial break here. We have the management of G Shipping joining us on the other side. Stay tuned. Coming up. Okay, welcome back. Markets, of course, not doing very much. We're about three-point change, nothing. But the story, of course, is that basically the fact that we've pulled up quite a bit from the day's lowest point. I think the low was made about 25,900, and we pulled about 60 points, 50, 60 points off the lows. And I think one big reason, of course, is Reliance Industries once again, which seems to be pulling its weight. It's up 1.25% on the day, and of course more from the day's lowest point. So 1554 on RIL. I think majority reason why the market is doing what it is doing. Now, overnight news flow, and maybe we can put that quote up from Ukrainian President Zelensky, sounding much more open to the idea of settling the war in Russia, and those graphics will come up. This is a US brokered peace plan, and Zelensky not going on the offensive like he has in the past couple of years, saying we're going to fight to the end, and we got support from European countries who've been urging him to continue the fight, etc., etc. Much more conciliatory sounding Ukrainian President Zelensky. Remember, it's a war which has gone on for 3 years now, over 3 years now. G. Shivkumar is Executive Director and CFO at G Shipping. Thanks very much, Mr. Shivkumar. Good to have you with us here. We've discussed this many times in the past. How material is this? Something of a ceasefire coming into effect, if it can happen. I think there is a deadline this week, 27th, which of course seems to have been put in place by President Trump. Go on.
Morning, Prashant, and thanks for having me. Yeah, so we'll await whatever developments happen, and this is of course a fast-changing situation. The first impact of a ceasefire. And we'll have to see what impact it has on the tanker market. So if trade patterns go back to where they were 4 years ago, before the start of the war, then the first impact is a negative for the tanker markets, because we had between a 5 and 10% ton-mile bump as a result of the change in trade patterns. However, then that's a negative for the freight market. So that's a negative for earnings if it happens. However, you'll have to see whether trade patterns actually go back to where they were. And just to remind you, most of the trade was between Russia and Western Europe. And Western Europe was heavily dependent on Russian crude oil and Russian refined products, which changed after sanctions came in, so on and so forth, in 2022-23. So the question is whether it goes back to the earlier situation, or you have this disruption happening permanently. So that's really, while a ceasefire could happen, and that would be good, we don't know whether the trade patterns will actually go back to where they were in 2021 pre-war. And that's really the critical point for the tanker markets.
So 5 to 10% drop and negative for earnings, basically, immediately, right?
And when I say 5 to 10% drop, that's in ton-mile demand. And the impact on rates would be much, much, much higher. So just to give you an idea, 4 years ago, rates for tankers, whether it's product tankers or crude tankers, were between $10,000 and $15,000 a day. Today, the rate for crude tankers, which is, and let's say the mid and slightly larger size crude tankers, Aframax, Suezmax, are $50,000 a day. Okay, and that's the kind of impact a 5% difference in ton-mile demand can have. However, as I said, the caveat is that is if trade patterns go back to where they were before the war, which is a little unlikely in most analysts' opinions.
Okay. Wow, 10 to 15,000 pre the war starting. This is tanker and product, oil and crude and tanker product rates. Tanker rates basically for oil and product, and now 50,000.
That's right. For crude tankers, product tankers, it's like $30,000 a day.
Wow.
So these little changes on the margin, 2 to 3% also makes a big difference on the margin because the market is pretty tight. And, once that change happens, then it's anybody's guess what happens to rates.
And you said if the product purchase thing remains, if it goes back, basically, which is Western Europe starts to buy from Russia once again in a big way, only then all this will happen.
Will reverse. Yeah, that's right. And then you have the second order impact, which is there's a lot of ships which are actually still here, and the fleet is very old, the shipping tanker fleet. And a lot of the ships are only still carrying cargo, though they are overage, because the market is so hot, because you're making $30,000, $40,000, $50,000 a day. And if the market drops, then the next impact is for a lot of ships to get removed, which then brings the markets back into balance.
Yeah. What happens to, because, the product market has also been very tight, right? I think 7-8 days back, there was that refinery in Russia, which was a major attack. But I think supplies, etc., have resumed from the port nearest to it.
Yeah, but refining margins are very high, especially in Europe. So there is a shortage, especially of diesel. I think even US gasoline inventories are pretty low. So there is a shortage of refined product. So oil is, moving from wherever it's available, even if it's a long way away. So there is, and refining margins, high refining margins, incentivize transportation of crude oil, transportation of refined products. So demand for tankers is really being driven by these refining margins and the amount of oil that's coming into the market, the crude oil which is being pushed into the market by OPEC.
Yeah. What kind of, what can happen if, do you have a view, because you're so closely associated here, these exceptionally high, margins, especially on diesel. Mm-hmm. If say there's a ceasefire or something, you think we can, what happens there?
Yeah, so you could have that Russian oil coming back in. You keep having these little disruptions from the attacks, the drone attacks on the Russian refineries, and that's what's taking out this capacity from time to time. We also have some refinery turnarounds happening in the Middle East, which is also resulting in more crude oil being exported out of the Middle East. And again, this happens in a cycle. You'll get those refineries coming back and maybe you'll get margins coming off again because they're exceptionally high now. We're talking $35, $40 in Europe. So that should probably come down because they are unsustainably high. You can't have them this high for much longer. But the good thing is that it helps the tanker market.
Yeah, and what could be the kind of impact here? I mean, just like you did for the, is there a way to tell?
You mean on the tanker earnings?
No, not tanker. So diesel spot cracks, as you said, $30 a barrel, right? Yeah. What could happen to it? $30, $40, as you said.
Yeah, I'm not sure. It's pretty high already. I don't know how much higher it could go. And again, we're not experts. We just say that, okay, this is high and that's what's driving the market and we enjoy it while.
No. I'm saying they could be, if there is more product into the market and Russian oil is back in the market in a big way, these cracks will compress. That's my point. Not about.
That's right.
So could there be a substantial...
The impact would be that they would come down a little bit. That's right. Come down substantially. Yeah.
Yeah. Okay. Come down substantially. And you would expect all of this to play financial markets respond, as you know, quick and fast. But this is the business of ships and routing and all of that stuff, right? So that takes time. But Do you expect all of this? If there's a ceasefire announcement, we wake up to a ceasefire announcement, you think all of this will play out very fast?
First, the EU has to remove sanctions. The EU has to accept it. Then the consumer, so the German consumer, let's say, who was earlier importing a lot of crude oil from Russia, has to go back to importing crude oil from Russia rather than from the US or from Brazil or from West Africa. So all of that has to happen. And this is not as easy as signing a ceasefire or agreeing a ceasefire. So that will take some time. Yeah. That will take a bit of time to play out in the tanker market. Again, sentiment, sentiment can change, but you need a lot of things to fall in place for trade patterns to go back to where they were before.
Got that. Now, just one last question, Mr. Shivkumar, and this is I'm moving away now from what the bulk of our conversation, actually all the conversation so far, which is this big push to the shipbuilding, make ships, at home here. Actually, a lot of countries are doing it. US is doing it. It is talking about it. What do you make of it, the push? I
think it's good to have a shipbuilding ecosystem, a shipbuilding and ship repair ecosystem, and a shipping ecosystem for that matter. As a large maritime country, we need to have a bigger shipping industry, which includes everything associated with shipping. So to that extent, we welcome it. It'll take time, obviously, to build this up, but you have to start sometime. And hopefully this can get built up into a big contributor. And so we are happy that shipping is on the radar of the government. As a big consumer of freight, as the Indian economy is, it's good to have a shipping fleet, an Indian shipping fleet.
Yeah. No, 100%. It's a critical sector in that sense. And China, by far the leader, right? In terms of the number of ships they make every year. Thank you very much, Mr. Shivkumar. And I hope we don't have to talk in the realm of possibility and soon we can say, well, the war's ended. And there's some semblance of peace in that part of the world. Thank you very much for joining us. Good speaking with you. Well, that's GE Shipping with some perspective on, the likely implications of this ceasefire. Which is it's looked plausible many times in the past, but I think closer than ever before. 25,992 is where the Nifty is at, and we're up about 32 points off the lows by quite a bit. We have Chandan Taparia, who's with us, Head of Derivative and Technicals, Wealth Management and Motilal Oswal Financial Services. Chandan, good morning. Good to have you with us here. Quick word on what the price action you're seeing and trades you would recommend?
Yeah, good morning. Thanks for having me. So we have monthly expiry and index got stuck in between the series VWAP and weekly volume weighted average. So as of now, if I look at the series on series basis, Nifty just flattish. But the good part is we have seen put writing at 25,850, and that is also the volume weighted average for the entire month. The only concern is that weekly volume weighted average is at 26,050, and that is not allowing market to move beyond that level. But the good part is that market is trying to absorb the supply near 26,000 marks from last couple of days. So major trend could remain positive. However, we may consolidate today with some volatile swings being the monthly expiry. But overall, I believe till it holds above 25,800, 25,850, index has potential to rally towards 26,100 to its all-time high of 26,277. The good part is that today the India VIX is down by 6%, and that is somehow adding some sort of support-based buying in the market. Now, talking about Bank Nifty index, Bank Nifty outperformed the broader market in this series, and Bank Nifty has comparatively higher base. As of now, it has been supporting or finding the key support at 58,500. So till it holds above the same, we are expecting a positive stance towards 59,250 to 59,500 marks. Now, talking about stock-specific idea, our first trade is buy on AB Capital. One of the strongest counter. Overall, longs are being added on series-to-series basis with positive rollover. In fact, multiple supports are visible near 325, 330 marks, and put writing also visible in the next series. So we are recommending to buy with support of 330, and this counter can head towards 360 kind of level. Second trading idea, that is from the auto pack, that is buy on Ashok Leyland. In fact, some short covering is visible in the counter. Consolidation of last 5 to 7 days is getting over. Major trend is positive, respecting well above its rising trend line. Rollovers are beyond 82, 85%, indicates bullish bias. So with support of 144, one can see an upside target towards 158 kind of level. And one more trading idea that will be buy on Nykaa. Strongest price pattern has been consolidating, but every declines are being bought. So with support of 264, we are looking for an upside target towards 285 in the Nykaa.
Thank you very much for that. After a slow start, the Nifty is back at 26,000 and Reliance Industries has been a big contributor. Stock has popped nearly 1%. Get into a break. On the other side, Manisha Gupta will focus on commodities. Stay tuned. Welcome back. As promised, let's talk commodities. Manisha is now joining in. Manisha, what are you looking at?
Precious metals, because overnight gains have been quite strong into this one. And after being stuck in a range for gold and silver, both of them, for most part of the last 4 to 6 weeks, we seem to be breaking range on the higher side right now. And this is majorly ahead of the lot of US data that's coming in as well. Today, you have the US retail sales, PPI numbers, home sales, consumer confidence, all of that data and some more is coming in today. And the important numbers that are coming in tomorrow is the US weekly jobless claims number. You have the durable goods data order. It also is about the third quarter GDP numbers and some more data again coming in tomorrow as well. Remember, it's a truncated week for US because of the Thanksgiving holiday there. And ahead of all of this as well, we also are looking at the US December rate cut probability on CME rise to a 79%. This is from 44% in the previous week. And that in turn also seems to be supporting gold and silver prices. There is a bit of a decline that we have seen for the dollar index that has come off its 6-month highs, also supportive. Many of these metals, not just precious, but the base metal prices have gained today because of this as well. Take a look at the gold prices then, and we have seen 2% of an overnight gain come in for this one. And with that, we are trading at around $41.50 an ounce. For the month, we are up by 4% and 58% up for this year. This is perhaps the best yearly gain that gold is heading for since 1979, with 58% of gains. For the Indian markets, the gains stand to around 63%. That is with the rupee depreciation as well. So we are looking at higher gold prices for the Indian consumers there. Take a look at silver, and we've seen 1.5% of gains in the overnight market for this one. It's 10% up for the month of November, and 78% of a return is what silver has given you for this year. And this is for the international markets. For the Indian markets, it is 84% of gains, taking rupee depreciation in. This is the best yearly gain that silver is headed for as well for a decade there. For the international markets, there's a bit of a disparity. And if you look at the premium, COMEX is paying it slightly on the higher side, but because COMEX has a silver inventory of 462 million ounces, while LBM stands and London stands at 844 million ounces. So London is trading cheaper. You have a premium that COMEX is paying and premium that much of the Asian markets are also paying, especially India, where the physical silver investment buying continues to be on the stronger side. And then it's not just about gold and silver. Platinum is up 74% this year. Palladium trading up 59% as well, with markets awaiting all of that data that US has to give in, and that would give you further direction.
Okay, Manisha, thank you very much for that. Well, as commodities in focus, we're going to take a quick commercial break here. Time for our special segment, Market Masters. Lata will be speaking with Harendra Kumar of Elara Capital on second quarter earnings, valuations, and his preferred picks. Stay tuned. Coming up.